Now we want to turn to the global market and what is happening abroad. What are some of the changes that we're seeing in general? So when we turn to just, Asian mobility, because this is the one that we've talked about the most in terms of what is normal, what is not normal, what are we seeing in general. So when we look at the Americas, but when we look at Japan, when we look at India, this is where we see some of this mobility. And you see a lot of this shortfall where you're getting this stagnation at these depressed levels. But Brent has shaken off a lot of these pauses, if you will, in terms of where things are going. And that this is something that we've alluded to and we've talked about, where it depends on where you're looking. Because when you look at the U.S., things have gotten better. When you look at 2020 versus 2021, U.S. and Canada has started to close that gap. We were down, if you look at let's say negative 2.9. We're still not quite there yet, but we're getting better. And this is where when you start shifting to other Asian areas and Europe, the question is going to be now. Some of this has slowed down in 2021, which is going to take us longer to recover what we did in 2020. This is some of the shortfalls where, because I know others will point to futures pricing to say, well, things are getting better. It's like, well, there seems to still be this disconnect between what is the underlying data saying versus what is the futures market saying. Now, you could say that they're looking into the future. This is what it is. But the front month, should all be reflected in the front month. This is something that this recovery should be reflected in, you could say into December and beyond. But that's where we continue to see a little bit of this disconnect between what is front month pricing saying versus what is happening in the underlying data sets. Now, when we turn to West Africa, you continue to see these drops in what activity looks like. And when we turn to the Congo, you're seeing the same type structure where it's the lowest since August. So Angola and the Congo have actually taken down their loadings this is looking at July. And then when we start looking at July for Angola, they took it down to a 10-year low again. But yet they're struggling to sell June, and that's why you could say that they have a resource problem. They're going to struggle to reach that, which is true, and they're continuing to find investors and trying to drum up additional support, such as what Nigeria has recently done. But you're still seeing this sluggishness in terms of trying to sell this crude into the market, which is why you're starting to see some of this pressure. Now, this is just looking at what we were talking about in previously when we turn to total road volumes in general in Italy and Spain. You're getting back to some of this normalcy. Where now, on average, you're only about, let's call it about 6.5, 6.3% below previous. And you're getting back to where we were as it relates to March. Now, Brazil and Chile is the one where we're starting to see a little bit of a residual slowdown. But again, things are still kind of getting back to or closer to normal. Then when we turn to the China and some of the vacations, one of the big ones that we looked at was Macau. And when you look at visitor arrivals, you can see that they've obviously gotten better, but they're really not getting to the levels that we would have expected. And it's twofold. It's one, you still have a certain amount of people within all of Asia, not just China, that are still facing some sort of COVID spike, some sort of restriction, which is going to limit driving and flying. But you also have a consumer problem. You have a shortage of retail spending, the consumer that is very uncertain, specifically in Asia, which is going to keep them from spending, which is going to keep them from driving and moving around, which again is going to kind of cap where some of this Asian demand is really going to come from. Then when we turn to U.S. exports, so U.S. exports came down a bit in gasoline and distillate. They were up a bit in propane and crude. But one of the things so now we can kind of touch on this in pieces. So when we look at finished gasoline, so gasoline was down 100,000 barrels a day, still up about 206,000 above the 5-year average, because we do have a bit more export into the Latin American markets, which is being fairly supportive of U.S. outflow at this point. The problem is going to be what happens when a lot of this product from the Middle East and Asia starts to show up in greater sizes. And we've already seen some of the cargoes that were destined for Europe turn and come into the Americas, which is something that is going to put some headwind on where our exports will go. Now, distillate is down. It's 195,000 below the 5-year average. That's something that we think is going to be consistent just because, again, you're getting that backhaul. And that you're getting those imports from the Asian markets into Europe, but Europe is still exporting into the U.S. So it's difficult to export from Europe into Pad 1 and then import from Pad 3. Instead, there's a better arbitrage when you look at coming in from Asia and the Middle East and then exporting some of that residual into Pad 1. So when we turn to just putting it into perspective, European imports of clean products from the Middle East, mostly middle distillate, will climb to a 7-month high. And again, so far we've had those 28 tankers, 1.86 million tons from the Middle East, with more behind it when we look at what is coming through, especially when India has already slated more product to come, actually more specifically into Europe. So then when we break it down on the different chart levels, you can see here that gasoline still remains elevated versus the seasonal average. We're going to continue to see this drift lower, but again, just within the top of the cloud, not coming back to the 9-year average, just because we do have some of that residual strength that remains in the Latin American markets. Now, distillate was the one that finally had kind of that big drop that we were expecting, back below the 9-year average. We just think it's going to live within this bottom range of between that seasonal low at the bottom of the cloud and that 9-year average, and we're just going to work within it as we do have some capacity into Latin America from the U.S., but our exports into Europe are still going to remain fairly tight. Just because the ARB isn't there, it doesn't make as much sense versus selling it internally or selling it into Latin America. Now, the crude oil side, we had another seasonally adjusted all-time high as we bounce back up. Now, our expectation was to see kind of this pivot back down into about 2.8. Instead, we got that other additional shift up. And as we said in segment 1, when you look at the rise in floating storage, the decline in imports, this is where you're going to get this flip where the exports are going to come down. You're going to get some of this import just because there's only so much space that these ports, these channels can really manage. So that's why when we look at it, we still think that 2.8 is the right number. It's just we were saying a range of 2.6 to 2.8. We will most likely not get to that 2.6 level just because we do have some of that residual strength that has come in from both Europe and Asia over the last few weeks in terms of purchases, which will support us because when you buy it now, it's not leaving immediately. It's you're buying it for a future delivery and loading date. So then when we look at propane, something that we were talking about of maintaining this elevated level, here we are again with LPG continuing to be demanded going into Asia. That's not going to stop. That's something that is going to be supportive of pricing internally. And even though prices remain elevated, it still makes economic sense to crack LPG to make petchems, again, providing some of that backdrop and that support for continuous flows. As we said at the beginning in segment 1, the ARA crude had a build. It built by about 1.3 million barrels, which again is very similar to what we drew down. So when you look at our side of the Suez, we're not going to see too much of a change. It's still below the 7-year average, but we're getting the rate of change is essentially up. As we get a bit more activity, as activity picks up within Europe, you're going to see refiners increase, and they're going to have to pull down additional crude to meet some of that new demand, which again is going to send this back up in terms. But again, we think it'll be below the 5-year average, but still trend in the upward direction. Now, when we turn to the loading schedule, when you look at June, you can see that June is actually dropped. And that's because when we look at Nigeria, we actually got more deferrals out of June into July. So we had 2 deferrals that were in April that got kicked into May. Then May got kicked into June, where we went from, essentially 1.5 and change in May down to 1.485. Then in June, we went up to 1.78. Now we're back down to 1.69. So you're seeing these continuous deferrals within Nigeria, which is, yes, it's keeping it off the water, but it's just showing some of the weakness in the West African market, which is speaking to both Europe and Asia at this point. Now, Angola, you could see that there was the deferrals from May into June, but now June is actually going to see some deferrals as well. So they pulled down loading. So initially, July was supposed to be over 1 million. It was supposed to be close to what May was, but they actually took it down to about 991,000 because I think that's going to open up the ability to get some deferrals out of June of 2 cargoes or so to get them back to 1 million, but they're leaving some of that open. Now, the Congo is the other one that we've talked about, where we're seeing some of the reduction into July because they were seeing that slowdown with some of those cargoes unable to move so far in June. Now, when you look at some of the shifts in general, Russia is now at a 14-month high in terms of exports. And we're seeing some different residual movements on pricing. So, some of the things that have come out recently in terms of Mideast diversion. So let's just talk about the products for a minute. So Europe's imports of clean petroleum products from East Asia, that 7-month high. 2 tankers hauling jet fuel and diesel from the Middle East to Europe have switched course. So some of those, again, we're starting to get so much into the Atlantic Basin that they're starting to adjust, which is why we talk about what is happening and moving into the U.S. markets, especially some of our normal markets. So when we look at Total, they bid 100,000 tons of Urals for June 6/10 delivery at $1.95 less dated Brent. It last traded at $2.10. Right now, when we look at some of the bids, the bid is now at $1.85. So you've seen a little bit of things getting a little bit tighter. And then Shell on the other side bid 80,000 tons of Siberian Light for June 15th to 19th at 85 cents below versus the yesterday's $1.50. So you're starting to see, again, some of that tightness coming back, which is a net positive. It's just when you look at what is happening, the refiners are getting hit now because of that. So then when we look at Ural crude export from Russia's 3 main western ports to the 14-month high of 1.7 million barrels a day in June, which is the highest since April of 2020 and compares to 1.56 million from May. Now, Congo, again, they're cutting some of the flows, and when we look at what has happened for some of the actual cargoes, now what I described is what is being bid for. It's not what is actually crossed. What is actually crossed so far. So Trafi sold 100,000 tons of Urals for $2.10, which the last trade was for $1.95 less dated Brent. So this is what's being current, but what is actually crossed so far still remains down. So we want to see some of this cross to kind of clear some of the glut. And then when you look at some of the other offers, so some of the other offers are for $1.65 below dated Brent. So you're seeing some of this tightness in some of the movements. But then when we turn to Asia and what some of the cargoes are for Murbain and some of these others, that's where we're seeing them shift away from West African bid and buying a bit more Middle Eastern crude just because there's a better differential at the moment. And that's where you're starting to see some of that activity. The other issue is teapots and I should say Shandong independents really haven't come back to the market in any meaningful way, which is leaving more West African crude because they're also a big buyer of West Africa. India, another big buyer over the last few months, they've also underwhelmed really in terms of what they've been buying, which is leaving more in the system. Again, really kind of creating this overhang when you look at some of the movements. Now, Euros have moved up. You're starting to see a little bit more bid for euros. India has talked about buying more euros. And it's when you look at them trying to get back to or increasing activity, it's going to be either Iranian barrels or euros because those are the cleanest swaps, if you will. So if Iran comes back, that's going to displace some of those euros, and then you're going to see prices reflect that fairly quickly when we look at how are some of these prices going across and what does that mean in general. So then when we look at West Africa, it's speaking of some of the OSPs or the official selling prices. Some were saying that, West Africa or Nigeria really has increased some of their OSPs. But it's important to kind of put that into context as to where are they versus historics. So the new price is negative 76 cents or 76 cents below dated Brent. It's still more expensive than 2020, but you can see the discount versus what it normally is. And this is just for one specific blend. We can show this for multiple blends where, yes, they've increased OSPs, but it's still well below what historics are. Because if you look, typically they have what we always call that Goldilocks crude of that medium sweet, which is why it's always traded at a premium to dated Brent. Instead, now it's at a fairly steep discount to dated Brent, which is some of that flip that we keep talking about as to, well, this is some of these big overhangs that remain, in the market. So now on the Fujairah side, we're seeing some of these drawdowns. This is some of that flow going into the European markets. So as of May 24th, Fujairah reported about 20.4 million barrels. Total stocks fell about 3.05, which is down 13% week on week. Light distillates fell 995,000 barrels, which was down 16.3% week over week. But the East of Suez gasoline market was under some downward pressure on those higher supplies regionally. And that's where we continue to talk about East Suez versus West Suez, because East Suez continues to have this elevated level of product that they're trying to push into the system. Now, there's OECD countries, then there's ones that I have data for or really show data, and then there's ones that don't, which makes it a little difficult. But guys like Kepler and some of these other companies allow for some granularity and Vortexa in terms of, well, what is the flow out there? How much is available? Which is, again, showing that there is still a lot that remains in storage, which is putting some of that pressure. India's private refiner issued a tender to offer up to 60,000 metric tons of 92 RON gasoline, which just speaks to another tender coming out, and this is for a loading in June 21st to 25th. So even though things are getting a little bit better in India, we're still getting more of that product being pushed off of the Indian coast and into the broader market. Then when you look at stocks of middle distillate, they fell 345,000 barrels, down 9.2% week on week. The middle distillate market was essentially fairly balanced just because there's less now expected coming from China, because remember they shifted the levy backdrop in terms of getting some of that short cycle oil or some of that diluent into the market. So now you're going to get some of this residual pushback, which should put a cap on some of the Chinese exports, but it'll shift some of the exports from other regions. It's still kind of an unknown right now how much, but that's going to be something to watch, and it should start to appear in some of these middle distillate markets. The market is set hopes of a demand recovery in Europe, which could translate to stronger pull from surplus barrels from Asia and the Middle East, which again we're continuing to see. Now the activity slowed a bit on the heavy residual side, but there's still a net draw. It's just the draw wasn't as much as expected, and you're going to start to see some of those builds come back into that specific market overall. Now, when we look at crude oil in the water, we had a nice little drop as we had a fairly sizable reduction in oil in transit, which speaks to them trying to work down some of their the onshore storage, trying to time some of these movements a little bit better and this is why we continue to see these deferrals, and we keep talking about the deferrals overall because it's hitting so far West Africa much harder than most. And that's when you look at to the oil in transit still remaining at a fairly depressed levels. When you look at the 5-year average, it's following the same rate of change and trend, just at a very reduced rate, given the elevated level of what's in storage, where they're trying to, again, manage and work things off in different ways. So then when we look at floating crude oil and floating storage, we're still at elevated levels, obviously not where we were in 2020, but you were still above where we were in 2016. Remember, speaking back to some of the big shift that we saw from 14 into 15, and then that really showed up on the floating side in 16 from the Middle East perspective. But this is where we continue to think that you're going to get that floating storage, again, shifting back up. Not to crazy highs, but again, remaining at the elevated level and the top of that range. As you can see, like the drop was fairly small. Then when we turn to what are some of the movements in product coming out of Europe, you can see that there was a drop in products across the board. You still see a pretty steady decline on gas oil, but that's going to start to reverse. And not to say that you're going to get these massive builds, but you're just going to essentially flatline as these imports start to show up from the other markets, specifically Middle East and Asia. Gasoline still moving in the right direction, but a lot of this is just going from one level to another, and it's just being shipped out of Europe into the U.S. markets, and you're going to continue to see this pull. The question is going to be how quickly can you get back to this average, because it's on a rate of change level it's strong and it's moving closer to this 15-year average. The question is going to be how quick can they get there. Or are we just going to see some of this, essentially a stagnation in mobility, which we've seen in other regions? Now, fuel oil continued to get a draw as it was getting recracked. We're starting to see that slow down a bit, just because now you're starting to see some fresh oil move back in, some of these movements in general, and now you'll start to see this flatline a bit. It'll still decline. It's just coming back to the rate of change. It's just going to flatline a bit and get a less aggressive, if you will, to the downside. Then when we look at Singapore, here you can see that we had a draw of about 1.6 million coming out of the system, but we're still at these elevated levels. And just given the shipments that, some of this has pushed off from Singapore, it will end up in the Atlantic Basin. And this is where the glut continues to remain in terms of what is in storage, what is onshore, what is offshore. And Singapore crack spreads have come back under pressure and have become a bit harder to see, just given where India is going, because India is exporting more. Is it going to get parked in Singapore, or is it just going to get sold directly into the Atlantic Basin? And the answer is, or at least it looks like it's going to be a mixture of both, which will be some of those headwinds when we look at where the product is moving. Now, when we look at middle distillate, you can see that we're still at a seasonally adjusted near those highs, the top of the cloud. There's just, based on what we're seeing in the different markets, I think that this is likely to stay at these elevated levels. Now, when we look at light distillate, you can see that bounce off the lows. The bounce continues to drive higher. This is the one that I think is going to trend back up. Again, it's going to be a steady increase, just as shipments show up that didn't get sold into the Atlantic Basin or into Pad 5. But it's just going to be kind of that timing delay as to when do they push off and head into the global market. Now, when we look at the near-term Brent time spread, you can see that it bounced off the lows, but it's still at about 14 cents. So Brent is still, and this is this weird shift between what is happening in Brent versus what is happening in WTI. As we've seen some of this tightness in the ARB, when you consider where Louisiana Light Sweet is, or LLS, versus Brent, and where we are versus MEH, or Magellan East Houston versus Brent, because that's going to, again, the pricing differential and the pricing shift is going to cap some of those U.S. exports. But when we look at the December to December time spread, you can see that there was a nice bounce off the lows. We've had this recovery back to, not the highs, exactly the highs, but again, back to this elevated level. And you can see WTI led that charge when we look at, that flat pricing or that stronger pricing in general. And it'll do well to keep the futures market that is looking at this and saying, well, this is clearly going to be good. This is something that's going to be strong. And this is providing some of that bullish backdrop, especially for the WTI, spread case. But then when we turn to refiners and what are some of the activities that refiners have seen in general, here you can see that we've actually gotten much weaker across the board and coming down to the levels that we haven't seen since mid-July, August of 2020, which is concerning when you're looking at activity, because this is normally when you start to see a fairly strong I don't want to say a big surge, but you're starting to see this bifurcation between what is light hydroskimming versus some of the hydrocracking. And this speaks to the problem on the light distillate side, the problem on the aromatics. We're just not seeing a lot of this capacity like the light, Arab Light, FCC, hydrocracking refiner margins on Arab Light. It's really Dubai that's providing any semblance of a positive spread. And this is where when we look at how can refiners really get operational, and is it because crude prices are too high and they just can't get an ARB? Are they not recognizing it or realizing it on the downstream, or is it a mixture of both that is resulting in this pressure on inherent crack spreads? And that's when you look at the Dubai hydrocracking, this is where we're pushing to the lows of 2021. Now, and that's why when we look at the 5-year average, you're typically starting to see some strength come into the market. Instead, we're just not seeing that strength come in, which is that softness that we keep talking about in Asia. Now, when we turn to Urals, things have essentially flatlined. There's not too much to write home about. As we start to see some movements in regards to spreads and some of the tightness in Ural diffs, that's going to put more pressure on those margins. Now they're going to have to try to sell them for a higher cut on the back end, but it's just given the imports from Asia, it's going to be difficult to see that. So we expect to see some of this additional pressure come through. And when you look at what normally happens in the summer months, we normally, if you go back to 2019, we typically see a nice little run that goes through June and then goes through September. And we're just not seeing that support, which is being reflected as well in the Mediterranean, as some of these spreads continue to drift to the lows of 2020 that we saw in the summer months. And again, this is some of that overhang that we keep seeing in the underlying market in terms of, well, where does the physical look like? How are things going to continue to move? And then when we turn to crude imports, right now, China super tankers, as we said last week, they dipped a bit. But this is something that we think is going to come back up. Again, just along that 5-year average, not back to the highs that we saw from 2020, because they do have a lot of residual to try to work through. And then the other issue is, so the data for the SOEs hasn't updated yet, but it did for the teapots. And you can see that they've essentially done nothing in terms of just that activity rate at maintaining that 66.7. As the government continues that crackdown and the levies take hold the middle of June, this is going to push these guys back down to the lows and trying to free up some of that SOE space. And this is when we talk about this permanent shift. So the one thing that we can all agree on is that Chinese imports of crude are increasing. But what does that mean for exports? Because right now we not only are imports increasing, but exports are increasing. So they're trying to do things to try to reduce some of those exports. But by doing that, you're going to just reduce imports of semi-refined goods and other types of oil, which again just reverberates through the system. So we're continuing to see this pushback, and you're seeing it hit rates specifically in Singapore when we talk about crack spreads, where Singapore, Malaysia, Japan, and India, and I should say South Korea as well, are seeing some of that pain. Now, Indian refiners were able to maintain some fairly elevated levels of runs through April and May, even though we had an increase in COVID. So now we're actually going to see that walk back a bit. They got hit again by another cyclone, the second one in 2 weeks. And now that they're starting to come into the rainy season, you're going to see some of these impacts in terms of, well, how much activity can come through. We've already had a port close and product get redirected. These are some of the shifts that are going to be that residual overhang in the Asian markets, which will put more on the water in the near term. But over the longer term, as China brings on more refining capacity, because there's more to come, which means that Chinese oil imports will go up, there will be more oil product exports, which is going to shift, where is this product going to get refined and where are the end markets, which is why we think that PADD 5 is going to see a continuous or at least a steady increase of just activity and imports from the Asian markets. Which is why when we look at Asian floating storage at a bit more granularity, this is going to come back up just because you have the issues from the cyclone and some of that residual as the Southeast Asian markets continue to struggle under continue to struggle under this elevated level of just product and COVID that is just going to be this residual. Now, again, we're not going to explode back to 2020 highs, but there's going to be enough to keep us well placed at the top end of the 2021 range, which you can see is clear above the last 4 years. Outside of 2021. Now, when you look at the North Sea, we're starting to get some of this gradual buildup as work has commenced on some of the pipelines. So you're going to see this stay fairly flat just because you're seeing some of the product come out as things are turned off, just to allow for pipeline work to be done. It started a day early. The hope is it ends a day early, but again, we're just going to have to watch this, which will keep floating storage fairly low on the North Sea side. Then when you look at West Africa, the trend continues to go up, and the deferrals, the goal is to keep this from being elevated. And so even though, technically this should go higher, the new deferrals should allow this to remain above the 5-year average, but still well above, the seasonal norms for this period of time. And they're going to have to essentially price things to move, which is why even though Nigeria increased some of their OSPs, we're not going to see too much movement on the back end. Now, the Middle Eastern side, we keep talking about where they sit versus historics, and just based on what we're seeing, we've had additional purchases coming through out of Asia, so we should actually see some of these floating storages decline and get shifted into the Asian markets, which will just take floating storage out of the Middle East and put it back over into Asia. Now, on the European side, this is going to be that dynamic between pipeline work, what is being brought in, timing delays. This, because of all of that commentary right there, it's gonna essentially flatline here. So we think it's just gonna be at the bottom end of this cloud and just go sideways over the next week or two as they try to manage their throughput. We've seen some of the pricing soften a bit in the North Sea and in Europe in general. So that's going to, again, trying to promote some of that movement, which will move some of it back through the system. Then when we turn to Shandong, you can see that they're back to this 2021 high. The pressure is always going to be, well, how are they going to refine it if they can't increase rates? They've already purchased product. There's pressure on some of the additional product that they normally purchase to bring in those levies. So that's where we think that this is going to still remain, obviously, seasonally adjusted all-time highs, but we think that we're going to set a new high for 2021. And then when we look at the fuel oil side, it still remains elevated and at 2021 highs and then seasonally adjusted highs over the last 5 years. These are the pressures that we continue to see specifically in Asia and some of the other areas, but that's why it's hard, because we're projecting forward and there could be surprises. Right now, the data shows that things, especially in the U.S., are getting better, but they're getting better along seasonal levels, and we're not getting that perpetual move up to get to offset, or that rate of change to close the gap. Instead, we're shifting up, but then we're going sideways after that shift up. We're not getting that steady move and grind higher. And just given underlying pricing, that's going to continue to kind of weigh and be the case over the near term. And just given the softness in Asia and the spreads here, you're going to continue to see those movements through the system. So thanks again for watching. If you have any questions, please let us know. I'm always available to go back and forth on some of the data points, because there's a lot of stuff out there. Even though these shows are long, there's still data that we don't even have time to cover. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.